As the state pension increases, but income tax bands remain frozen, you're in danger of paying more tax in retirement. So in this video, I'll explain how taxes work in retirement and how you can pay less. If you're new to my channel, I'm a qualified accountant and experienced tax advisor. First of all, there is a tax that you will stop paying when you retire. Do you know which tax that is? It's national insurance. So most people will stop paying national insurance when they retire, even if they continue to do some work. The exception is the self-employed, who will sometimes continue to pay Class 4 NICs. So what can you expect to pay tax on when you've retired? First of all is the state pension. Lots of pensioners are dependent on the state pension in retirement, and the new full state pension is £221.20 a week, or £11,500 a year. This is taxed as earned income, which means that it's subject to income tax. But most people in the UK are eligible for the personal allowance, which is £12,570, which means that you can earn that much before you have to start paying any income tax. If you're a very high earner, then you won't be able to receive the personal allowance, but most people in the UK are eligible to receive it. So that means that if the state pension is your only source of income in retirement, then you won't pay any income tax on it. But £11,500 is not going to be enough to fund your retirement. According to the Pension and Lifetime Savings Association, a single person actually needs £43,100 a year to have a comfortable retirement. So it's really important that you have other income sources to complement your state pension. An example of this is a private pension. Two popular types of private pension are the workplace pension and the personal pension. With a workplace pension, your employer will usually match whatever contribution you make, so it's a really good way to get essentially free money from your employer for your retirement. And then in terms of the personal pension, a really popular option now is the SIPP, or the self-invested personal pension. And that's where you can choose your own investments, and it's completely independent of your employer, although your employer can contribute into it on your behalf. If you're self-employed, it's really important that you consider having something like a SIPP, because you won't have access to a regular workplace pension, and it's really important that you're investing for your retirement because the state pension won't be enough. The SIPP is an effective way to maximize tax benefits whilst planning for retirement. When you pay into a SIPP, you get a 20% top-up from the government, because your pension provider will claim your basic rate of tax relief from HMRC and then pay that as cash into your pension. And if you're a higher or additional rate taxpayer, you still get that additional tax relief from HMRC, but you just have to claim it through your annual tax return. When it comes to SIPPs, you do need to be careful of fees, because that can significantly impact how much your pension pot can grow. And that's where I want to mention the first sponsor of today's video, Invest Engine. Invest Engine offer a fee-free SIPP for DIY portfolios to ensure that you're not overpaying for your pension. That means that you can choose your investments commission-free and invest in a wide range of best-in-class exchange-traded funds without paying more than you have to. Head to investengine.com/SIPP to find out more. Like the state pension, a private pension is taxed as earned income, which means that it's subject to income tax. And if you've taken the full state pension, you're not going to have much of your personal allowance remaining, which means that when you start to take money out of your private pension, you'll be paying income tax on it. You can usually take 25% of your pension pot as a tax-free lump sum, and that's capped at around 268k. But after that, you will start to pay income tax on money that you withdraw from your pension, and it's taxed at your highest rate of income. So that means that any other income that you receive in retirement, so whether you're still receiving some salary or maybe some rental income, your pension income will be added to that, and then your tax will be calculated for the year. As a reminder, the income tax bands are 20%, 40% and 45%. How you take money out of your pension can really impact the amount of tax that you end up paying. And I'm not going to go into all of the options in this video, because this is a really complex area and you should receive individual advice from your tax advisor or your financial advisor if you're thinking about how to take money out of your pension. But there are a couple of tax-specific points that I wanted to mention. So first of all, you can withdraw money from your pension as a lump sum. This isn't necessarily the most tax-efficient way to take money out of your pension because you might end up paying more tax than you need to. If you're taking all of your money out, depending on how much is in there, you could end up paying tax at the higher or additional rate of tax, which could potentially be avoided. So you might want to consider an income drawdown, for example, instead. That means that you can take your tax-free lump sum and then you could leave the rest invested so that it continues to grow, and then you can take the money out as income or installments. And that could mean, depending on how much you take out, that you avoid paying the higher and additional rates of tax on your pension income. Planning for retirement can be complex. The second sponsor of today's video, Tax Scouts, can help you to make tax-efficient decisions for retirement. With Tax Scouts, you get expert one-to-one advice from a real accredited accountant. It couldn't be simpler. First of all, you'll get personalized advice in a telephone call or a video call. Then your accountant will send you a summary of everything you discussed with clear next steps tailored to you. Whether you need help with your self-assessment or tax deductions or anything else, your accountant has got you covered. Use my link in the description box to get 10% off. Next, let's talk about assets. So if you hold assets in retirement, you'll be subject to capital gains tax when you sell the asset, and you'll be subject to income tax on any income that those assets generate for you in your retirement. That applies to investments that are held outside of your pension or ISA, and it applies once any relevant exemptions and allowances have been taken into account. So for example, with capital gains tax, you have a £3,000 tax-free annual allowance. And with savings interest, you would have your personal savings allowance, which changes depending on which tax band you're in. So to lower your tax liability, you could consider giving assets to your partner if your partner is a basic rate taxpayer and you're a higher or additional rate taxpayer. In terms of the capital gains tax consequences of making that transfer, if you're married, you wouldn't usually pay any capital gains tax on assets that you give to your spouse. Next, let's talk about dividends. So again, this only applies to investments that are held outside of your pension or your stocks and shares ISA, because those are tax wrappers that protect you from paying any dividend tax on dividends that you receive. But if you have a share portfolio and you receive dividends of more than your annual dividend tax-free allowance of £500, then you will pay dividend tax on any dividends that you receive in retirement. As a reminder, the dividend tax rates are 8.75%, 33.75%, and 39.35%, depending on which income tax band you fall into. So those are 4 common sources of income in retirement, and as you can see, it's likely to be income tax on your private pension, which will be your biggest tax burden in retirement. But there are things that you can do to make the way that you withdraw your money more tax efficient. I hope that you learned something new, and if you did, please do like and subscribe. I'll see you next time.